In today's video, I'm going to show you a better way to get very high yield in your portfolio. Nowadays, there is a lot of chatter about YieldMax ETFs, which has a very high distribution percentage yield, TSLY 50.73%, NVDY 49.98%. But one of the issues that has come up in recent days is understanding capital erosion or now erosion with high yield dividend stocks and ETF, which means YieldMax ETF TSLY, which mirrors the Tesla stock, is down 29.94% as of today. TSLY, which came up last December for $21.76, is currently trading as $14.32, and which was at its 52-week low at $12.53. That means although you got a pretty hefty dividends distribution, if you had bought 100 shares of TSLY in December 2022 at $21.76, which is $21.76, your portfolio value for TSLY today would have been $14.32. So on an investment of $21.76, you are down by negative $744 as of today. So the way YieldMax ETFs works is by employing synthetic covered call strategy, and I'm not going to go into too much details into the synthetic covered call strategy, but in essence, let me just show it to you how YieldMax ETF employs this strategy versus the one that I find is a bit superior than the YieldMax ETFs. So this is the traditional synthetic covered call strategy in which one will not have any shares bought, but instead of buying 100 shares, one will trade something like this. If the stock is at $100 price, the first step will be to buy one at the money call option, which is you will buy call options at the 100 strike price, and at the same time you will sell one at the money put options at the 100 strike price. And then the third step will be to sell 1 month or less call option with 5 to 15% strike. For example, if the month is October, you will sell November call option with a strike price of $105. But what will be the anticipated problem here? If market is bullish, you will continue to get premiums, which is fine. But if market or stock goes down, your anticipated premium will be less, so less distribution over time, and which means now or capital erosion. If you remember, TSLY, which was at 21.73, is currently trading at $14.32. So what is the solution? I have developed a superior synthetic covered call strategy with additional steps, and I will describe here. Step number 1, for example, you can I traded Apple, but you can also do with the other ticker symbols as well. AAPL trading at 170 on October. The first step will be I bought one Apple January 16, 2026, 170 call at 37.65. The reason I went for a really long expiry is that I wanted to just get this option strategy to work a little longer, but you can choose anywhere from 6 to 12 months or as desired. So the normal synthetic covered call strategy would ask for selling a put at 170 because Apple is trading at 170. You buy a call at 170, you sell put at 170. But in my strategy, what I have done, I have sold Apple 1 January 16, 2026 230 strike price put for $57.60. If you remember, in step 1, I gave up $37.65, so I gave $3,765 from my own pocket to buy Apple call. Now in step number 2, what I've done is I sold put for $57.60, which is $5,760. So my net gain so I have a net gain, means the amount of money which went from my pocket is now more than the one that I spent earlier to buy a call. And so, which is nothing new, and means when you buy a call, you give money out of your pocket. When you sell put, money comes into your account. But in this case, the strategy, the way it's different is, I'll explain to you. Let's move on to step number 3, and then we'll go with the rest of the steps for this strategy. So step number 3 is I sold one Apple October 6, which is 1 week, 175 call options for 79 cents, which means I received $79 premium for 1 week. And so step number 4 are 2 additional steps that I have added to in my strategy. And step number 4 is you will buy, and I bought one Apple January 16, 2026, 170 put for 21.75, which means Apple currently trading at 170. In the regular synthetic covered call strategy, you buy a call, you sell a put, and you sell another weekly or a monthly call. But what happens if Apple goes down from 170? You don't have much of your protection here. Apple could go to 150, it could go to 120, it could go to 90 or 80. And so in this traditional synthetic covered call strategy, you would be just losing your premium, because when the stock goes down, you don't get the premium much, and you cannot sell in a loss your weekly or monthly covered call. So in this one, what I'm doing is doing a particular limit here, that Apple should not go below 170. And for that reason, I bought one Apple January 16, 2026, 170 put for 21.75, which I had to give it from my own pocket. But what I've done in step number 5 is this. In step number 5, I also sold one Apple January 16, 2026, 195 call for 25.65. So there are several steps. It may be a little bit confusing, but the overall idea is to mimic the synthetic covered call strategy, but with a better protection. So at the end, if we calculate it out, I bought a call at 37.65, which is negative. I sold a put, which is positive 57.60. I also bought another put, so negative 21.75, and also sold a call at 25.65, plus there's a little bit of premium for $79. Altogether, the net gain is $2,385. So idea here is not looking at the net gain, which is good in any case, but to get the premium from weekly or bi-weekly or monthly call options. As long as you have solid foundation for your 170 call and 230 put that you sold, you actually mimicking the 100 shares of Apple. So you, in a sense, you have 100 shares of Apple. You will be selling a short-term call, but at the same time, I have also bought a protection, so Apple cannot go down 170. If it goes down 170, you have 2 protection for you. One is 170 put that I bought it, and also 190 the call option that I had sold, 195 call option that I sold. So in the event Apple goes down, I have at least 3 protection. In the event that Apple actually goes up, I have 170 call, which is at the money, so it will work same as the Apple shares. And I have also sold a very deep in the money 230 put, which means in the event that Apple goes very high, 230 put will be in positive, as well as the 170 call that I bought will be positive. So I'm just playing on both the sides. Let me know in comment section what you think, or if there is anything that can be either change or add here to make it more superior strategy here. Talk to you later in the next video. Please like and subscribe.